Hello everyone. Today we are going to talk about practice of business combinations IFRS 3, calculation of the goodwill and calculation of the NCI and how calculation of the NCI actually impacts subsequent measurement. Let's assume that we are acquiring the company and we are paying 1.2 million for 8% of the shares. This means that our non-controlling portion is only 20%. And we can also calculate the fair value of the NCI. The first method, we can assume that if we paid uh, 1.2 million for 8%, then 20% should be 300k. But it doesn't work like this in the practice because there is a premium for the control. If we are obtaining the control as well as the shares, then we are paying more than when we only purchase the shares. For this, 20% of the shares are actually valuing less than 300 k, and the control premium I put here 10%. It can be like 10% or 15% in telecom industry and other industries, and after considering this control premium, our fair value is 270 70k. And let's assume that we have to consolidate this balance sheet of the equity. So we have to see its net assets, book value of net assets, and fair value of net assets. Because when we consolidate, we will consolidate fair value of the net assets, not only book values. And here we see that book value of the net assets is 1 million, and we are doing fair value assessments over the book value of the assets and liabilities of the company, and we identify that there is uplift in PPE, intangible assets, and there is 20% deferred tax impact of this uplifts, and our net fair value of adjustment is 320k, and fair value of the net asset, total fair value is 1 million here, and plus net fair value adjustments. This is our net assets. And now we can calculate the goodwill. For goodwill, we have two options. Full goodwill method, where goodwill is attributable to equity shareholders and as well as NCI, and in another option, goodwill is attributable to only equity shareholders. In the option one, where the goodwill is attributable to only equity shareholders, we calculate consideration paid. This doesn't change here, 1.2 million. NCI, it's calculated as proportion of net assets, and we have the total net assets, and NCI portion is 20%. This is a NCI, and our fair value of the net assets is this one, total fair value. Calculation of the goodwill, we are summing consideration paid plus NCI and minus net assets. And total goodwill is attributable to only equity shareholders, no attributable to equity to NCI in this option. And second option, we are calculating NCI at fair value, goodwill, full goodwill method, and part of the goodwill will be attributable to NCI too. Consideration paid doesn't change here, but NCI portion change here because calculating NCI from fair value. And net asset also doesn't change, and we have the goodwill in full goodwill method, 150k. And how to split this between equity shareholder and NCI? It says that as based on 10% of ownership, and this one we are multiplying by ownership percentage, and remaining will be attributable to NCI. Under IFRS 3, both methods are acceptable, allowable, and you can use any of them. It's a policy choice, but you have to be consistent. You can't select one for the one accuracy and another one for another accuracy. You have to be consistent, and it's allowed. And what differs these methods is, are actually subsequent measurement. In subsequent measurement, when goodwill is impaired, in option one, this impairment is fully attributable to equity shareholder and will be reflected in profit or loss at the full amount. In option two, where part of the goodwill is actually attributable to NCI, when the goodwill is impaired, equity shareholder portion will be in P&L and other portion will be in NCI. And that's it. This is a total impact of this goodwill calculation using two different NCI methods. Thanks.